Let's bring in Kevin Green, senior markets correspondent, to help set up the action today. All right, KG, let's start out with, kind of a look back at this quarter. When you think about how it started, at the previous quarter, I should say, and how it finished, what was the biggest surprise for you?
Obviously, the turnaround. I mean, we saw that dramatic drop to the downside around the tariff announcement, and then the abrupt reversal from the White House and the buyers that kind of stepped in. Not only just short sellers that are getting covered and were squeezed to the upside, but new buyers actually stepping in around those lows. And then momentum continued, obviously, throughout the quarter, and we ended up pretty strong, obviously hitting all-time highs yesterday, and hopefully we're able to see some follow-through over the next couple of weeks or so. I think that was actually pretty remarkable. It's not surprising that you still saw sectors that we know and love, like information technology, communication services, continuing to catch a bid, even when we had that sell-off. It's really the sectors that we know. We know that they are high performers. A lot of them are really good cash providers as well when you're looking at their cash flow. So it seemed like, obviously, we may have overdid it to the downside. Now we have buyers kind of stepping in. We might have overdone it to the upside. We haven't had any type of retracement back to test some of these key technical levels lower. But when you're looking at the opportunity within the S&P 500, there's still around 49, almost 50% of stocks that are still below the 200-day moving average. So that means that, yes, we are at all-time highs, but there is actually still some room to run here, maybe some opportunities at the lower end of the spectrum here for the S&P 500. So that could actually give you a little bit of optimism. I think the only thing that makes you a little bit concerned, Diane, is the movement of the dollar and how aggressive it has been over the last couple of trading sessions, trading near the lows right now. And then also looking where yields are, we are seeing a significant bid in bonds. You are seeing yields move to the downside. And that's just something to kind of keep on your radar. Are we going to be close to a cut? That could be the case, but are we seeing the dollar being sold off so aggressively because of the prospect of economic slowing here in the United States? Is it because of this bill that's moving through Congress right now? There's so many different factors. And then we also have still the headline risk of tariffs over the next couple of weeks as well, which it seems like the market has significantly discounted.
When you think about the weakness in the dollar, how much does that matter when you compare to the scorecards of the first half of the year, when you think about equities, bonds, et cetera? Because it doesn't seem to be, not that it shouldn't be paid attention to, but it doesn't seem to have the significance that it would imply by the levels.
Well, I would say it's the rate of change to the downside, not really where the dollar kind of ends up, and it will have an impact. In fact, you're actually seeing that this morning. If you're looking at the futures products that are outperforming right now, everything that's a metal, no matter if it's a precious metal or an industrial metal, is up over 1% right now. And that's probably the reaction of that dollar moving weaker. You're also seeing oil move to the upside here this morning as well. So there's a lot of commodities that are sensitive to a weaker dollar. A weaker dollar actually makes it a little bit more attractive to be able to export a lot of those commodities out of the United States. And that could also raise demand internationally. And that could actually push up prices on the commodity front and then on the inflationary front as well. So you don't want to see it move too quickly to the downside, because that's where it can create a little bit of a problem. And then also purchasing power for your U.S. citizens and U.S. buyers of consumer goods like yourself and myself also gets withered away. So you will see this inverse relationship with the dollar moving lower and equities moving higher, but there's also going to be some commodities that move with that as well. And that's probably not what you want to see if you're trying to have, obviously, rate cuts because we have achieved lower inflation, or basically the disinflation type of narrative that we've seen over the last couple of months here. So I would just get, a little bit, just keep it on your radar for that rate of change. If you're looking for a firm area of support, and we are going through a cycle, if that's what you believe that's happening right now, you look at the $90 level on the Dixie, the dollar index, as your firm area of support. If you kind of go back and look at previous cycles where the Fed's cutting rates, maybe we have a little bit of a pullback when it comes to the equity markets. The 90 to 92 level range actually is a firm area where the market really starts to buy back into the dollar. So a lot of different dynamics there, but the rate of change is a little bit concerning.
I want to go back to the point that you made about the strength in certain sectors and going back to beloved sectors when you saw, kind of the whip around to more bullish sentiment like information technology. What are you anticipating for the second half of the year in terms of sector strength? Are you anticipating a sector rotation or more of the same?
Yeah, you would hope you would actually see a little bit of a sector rotation, not an aggressive one, but having more sectors actually participate is always going to be good for markets because it's harder to kind of sell those markets off. So we've already seen industrials actually kind of lead the way, making new all-time highs. That was really led by Boeing as well as Deere and Caterpillar for that matter. But if you're looking under the hood in industrials, you still have freight movers like rail, the UNPs, the CSXs of the world that are still kind of lagging behind materials, which is a very small portion of the overall S&P 500. If we do see this commodity move or the commodity cycle happening because of the dollar, they could also see a bid towards the latter half of this year. Consumer staples probably going to be the biggest one at risk. From a valuation standpoint, it's still a little bit expensive, and we have seen maybe a backing off, especially when you're kind of looking at companies like a Walmart here. So each and every sector has their own kind of benefits as well as drawbacks for the second half of this year. I think if you're looking at technology and semiconductors, we are trying to see, or we are attempting a breakout to the upside. If you're looking at the SOX, the Philly Semiconductor Index here, the biggest risk that you have is trade plans and frameworks actually falling through, and an escalation between the U.S. and China and continuing to either revoke waivers or restrict some of their technology. It seems like the market's already pricing in that we're going to see that actually being relaxed over the next couple of months here.
When you think about the cash that's sitting on the sidelines, there's still a significant amount of cash on the sidelines. Do you think FOMO, given the momentum that has been occurring towards the end of this previous quarter and kicking off a new quarter, do you think that cash gets to work in the second half, in terms of flows towards equities, or do you think investors are still too cautious for a further melt up?
Yeah, that's a good question. So the cash on the sidelines, I think everybody kind of looks at the money market funds, and there's $7 trillion on the sidelines. Some of that capital will be put into the equity market, but not all of it. And I think that's kind of something that we have to be mindful of. But if we get rate cuts and rates do go down, a lot of that capital that's sitting on the sidelines right now is really for CapEx spend for larger corporations, and they're making a lot more money holding it in cash or holding it in treasuries rather than deploying that capital for new projects, for new buildings, for buying real estate, things of that nature. But if you do have rate cuts, that could actually spark some of that activity. So I look at that cash on the sidelines as a piece of the pie. Some of that, let's say 10, 15% of that will be deployed in equities as well as treasuries and fixed income. But a significant portion of those dollars will actually be deployed within the economy. And that's actually going to be the one that actually provides and sparks economic growth for us over the long term. So will we see it? Yes. Is it going to be the total amount that has been cited a lot? Probably not, Diane.
And let's talk about the progress with the one big beautiful bill, the legislation that's making its way through Senate. They're going on 24 hours with the policies that the Senate is looking at and the different measures there. How do you see markets reacting if it does pass to essentially a new wave of fiscal spending, KG?
Well, I mean, if they're not prepared for it right now, Diane, then they got a little bit of a problem. It seems like the market probably already has this, priced in for the most part. I think that's why another reason why you're seeing the dollar, among other reasons, that the dollar is moving to the downside. There have been reports that J.D. Vance is on the Hill right now, so he could be the tie-breaking vote within the Senate. There's a good thing and there's a bad thing with that. A good thing is if he's going to be the tie-breaking vote, obviously it sounds like the bill's going to go through. The bad thing with that, it sounds like they probably did lose a senator overnight, and obviously there's been a lot of political backlash and commentary around Medicaid cuts, among other things. So it's not very popular when you look at the polling, even some of the conservative pollsters that are out there. But it seems like they're probably still going to get it through. The question is going to be the House. The House is really not going to have a lot of time to be able to read this bill if they want to get this on the president's desk by Friday. And this passes, say, tonight, they have pretty much one day to read over 980 something pages of legislation, which is probably not going to happen.
It is massive. I tried to go through, some of it. I mean, it's a lot. All right, so let's get your targets really quickly on the S&P 500. We finished at a record yesterday, 6204. Where do we go to the upside and downside?
Yeah, to the upside, looking at resistance at 62.30, to the downside 61.70. You are seeing volatility kind of re-rate higher for a second day, so keep that one on the radar here. We're starting to see a little bit of a divergence between vol and equity realized vol here.
All right, that's our Kevin Green, senior markets correspondent here on Schwab Network.